gave up tenure twice. And for those of us who have been at Columbia, we know how hard it is to get tenure at Columbia, so giving it up twice is probably reflects the degree of insanity that pervades in my mind. The other thing that I would just say before we get going is we were debating business casual or Peter is staying at my home this weekend, and he walked down in the suit and a tie and everything. Now, those of you, again, who know me pretty well, it's very rare. I'm the only person on the faculty, I think, who's always at Columbia with a tie on. So this is sort of an interesting contrast in terms of the relationships we have. So with that, I'm going to welcome you on behalf of CEASA and Stephen and myself and the rest of the Columbia faculty. We really appreciate so many of you coming. We had originally booked a very nice auditorium that's on a floor up there, and we had such overwhelming interest that we came into this somewhat larger room. And people have come from all over. We have some hopefully really interesting discussions. And the one thing I want to mention before I move to us is there are almost as many interesting participants as there are people who are going to be on the podium. So we are trying to make sure, and we've asked all the moderators to be very aggressive in keeping people to their sort of allotted time, so that we can get some interesting questions and get people from the audience to actually participate. So please take advantage of that. What I wanted to start off with was just giving you some sense of why we felt so passionate about getting this subject into the discussion. So why uncertainty versus risk? Those of us who've participated in the business world over many years, and that's what you'll hear soon, is everybody, especially as you get more senior, wants simple answers. The world's so-called too complex. So in the simple world of the markets, we often talk about PE multiples or, God forbid, an EBITDA multiple. And various summary statistics, and my longtime mentor, Jim Olson, has always sort of said, we need to get that summary statistic, or we're looking for that summary statistics, the core earnings or whatever, that gives us the multiple. The world doesn't work that way. And so we're all trying to get these summary statistics or summary measures. We measure risk today in certain ways to try to capture that. When we look at the teaching, the number of conversations that many of us, I'm sure, have had about our students want to have a formula that they can take away so they feel they can go and do something. And they feel very dissatisfied if we leave them feeling that actually the answer is it depends, which is how I try to leave my accounting classes. The key is there's no simple truth, everything depends. And then when we get to our research, those of us who do at least the empirical side of the research, we have to come up with statistical analyses that are robust. We always talk about all these correlated variables, and we always try to get rid of these outliers. And yet, in many ways, that's what the world's about, as we are experiencing constantly. So as we go through this, as Peter mentioned, what we're trying to do is generate some really interesting questioning and thinking. And I would tell you, I've done many, many things in my life, in terms of business anyway, and I just feel that we are totally lost when we talk about these particular issues. And there's a real challenge ahead of us, particularly with the proliferation of data and information. When I did my first research study with Jim Olson, I read microfiche and hand-collected everything in our library. Today, there's this proliferation of databases that people just try to find a question to do. And somehow we've got to bridge that gap. So what I wanted to just sort of frame, and then we'll go through this to some extent in the conference, is the differentiation between risk and uncertainty. And the first set of dimensions is it measurable? Is it manageable? And what does that mean from a sort of profit-generating perspective? And actually, Don Chu was the one, when I first spoke to him about this, who reminded me about a particular set of definitions of this, or probably some of the earliest. So what I wanted to do is just share, I don't know, I hope you can see that, but share what some specific statements have been made from this one book that I found on Kindle, actually. So this first statement basically says risk means in some cases a quantity susceptible of measurement, while at other times it's something distinctly not of this character. And there are far-reaching and crucial differences depending on which is present. Then the measurable uncertainty is actually what they call risk proper. So the essence of this is that true uncertainty is unmeasurable, and actually that's where profit comes from. So if we can measure it, we can actually ascend, and that's, if you think about it in the academic world, that's the no arbitrage conditions in some sense. And we spend a lot of time talking about how to manage risks, and my colleagues on my left here will express how they do it in their businesses. And then I love this one, which is uncertainty is one of the fundamental facts of life. It is ineradicable, although I didn't really know that word, from business decisions. Okay? And then the aspect of this, the last point, is that we try to assign probabilities, whether we're in practice or we're in academia, to these so-called risks or uncertainties. And yet, we skip the way that we all internalize these. And actually, one other dimension of this that we didn't really talk about is we all make estimates. And I have said to many of my academic colleagues and those who know me from my work at Morgan Stanley is most estimates you get are fundamentally flawed. And the problem is the way we teach it, we set people on the wrong path. Okay, so we'll get to talk about a little bit more about that. And all of this, by the way, was written in 1921 by Frank Knight. So this is not something new. The issue is how we deal with it right now. So with that said, here's what I wanted to just sort of frame. I think that what we really know is risk, and we spend a lot of time thinking about how we measure risk. And my guess is most people, when they talk about it, this is what they're talking about. In terms of how manageable risk is, how profit-generating is, we'll hear from a lot of people who actually think about this all the time. Education and research, we spend a lot of time on the risk side. The policy dimensions of this, my own experience, Bob Hers and some others who've been involved in policy here will comment over time. This is not something that the policymakers necessarily internalize quite as well as they maybe should. But when we get to this uncertainty dimension, there's all these question marks in my mind about how we do with it. And the challenge that at least we would like to put to this group is there must be better ways that we can bring our thinking and our ideas and our discussions to actually addressing this, because we'll all be better off for it. So in that context, let me tell you a little bit about the conference. Can we move one more page? This is not moving. Nope. Thank you. So what we're starting with is, and I'm going to introduce why I begged and cajoled and sometimes some other things with my three speakers, panelists just now. But what I wanted to do was give you some perspective or hear from people who have experienced risk and uncertainty from some quite different perspectives. And so this is the experiencing part. Then we have some academics, or not just academics and practitioners actually, who talk about what we learn from their different work on assessing uncertainty and risk. So it's the experiencing of it, what we've actually learned from the work that we've done. Some of it will be more fulfilling than others, perhaps. And then we have a very interesting panel again after lunch, which is a mix of people who are dealing with coping with uncertainty and risk. So we have, for example, an analyst who was in the banking, head banking analyst during the crisis in Japan, and then was the same banking analyst in the crisis in the US. I'm not sure if she led it or just had to suffer from it. But she's sort of got that multiple perspectives. We have someone from litigation, we have someone from auditing, we have a regulator, and we have Greg Jonas, who's going to manage all that, who certainly has dealt with lots of risk and uncertainty in multiple parts of his career, as he will explain to you. And then we have an interesting panel on one of the measurements that's out there that's debated a lot in all these dimensions, which is the fair value aspect of it. This evening we have what Peter and I have seen a version of, a fascinating discussion by Major Jones from the US Army, who has lived and is now teaching for a while at West Point on how the Army deals with uncertainty and risk, and I think you will find it quite interesting and revealing. And then tomorrow, we shift focus a little bit. One of the problems we had in setting up this conference was there were too many different things we could bring to the table. And one of the most controversial issues, and yet one that I also think is also not quite as, people don't appreciate how complex this is, and I'll talk a little bit more about this tomorrow, is the capital and liquidity aspects of it. Again, we teach it, we have to deal with this every day in practice, and yet it's something that we don't deal with all that well. So let me tell you about the people on my left. And again, I'm not going to give you their bios are inside, but I want to give you a sense of why I asked them to help us. So Neal Shear started and basically built the commodities business at Morgan Stanley. And what's interesting, he'll talk about this, but what's interesting in that business was it was one of the few instances that I came across where there was something explicit in the way that the business model that was created to actually try to manage both the risk piece and the uncertainty piece and create a business around it. What happened after that was he was so successful that they asked him to head up sales and trading at Morgan Stanley. And so he sort of tried to transform some of that process, if you like, into the larger setting. So he's going to talk a little bit about that. And because we didn't want to just keep it Morgan Stanley, he also went to UBS and took over that role at UBS. So he's seen it from multiple perspectives. So Neal will, I think, bring you a perspective that's truly unique. On his left is Steve Grisky. And I have to tell you that Steve, I worked with when I first moved to Morgan Stanley, and is one of these people who has so much energy, so much interest, so much intellectual curiosity, and is truly a unique person to have here. We got an email a few weeks ago from his assistant to say Steve can't come to the conference because he's got to be in Korea. So I quickly reached out to him. Basically, I don't bow to anybody, but I begged him to participate. He flew back from Korea basically last night to come to the conference. Neal actually also flew in, flying out straight from the conference as well. So Steve has this really unique perspective because he was an auto analyst for many years, and he used to have in his office this sign of, it was a New York Times sort of copy that had as the big banner headline, Grisky upgrades GM, because he was always very negative, or many years was very negative on GM. He left Morgan Stanley, and nobody on the buy side or sell side would do anything in the auto industry without talking to, including many of the corporations, without talking to Steve. He left to go and advise the CEO and CFO of GM for 6 months. He then left and went into private equity and bought out some auto parts companies. He then went and joined the board of GM post-bankruptcy, and recently became, or not so recently, but became the vice chairman and gets more and more responsibility as GM. So he's seen it from every side of this, and hopefully will be able to share some of that with us. And then on his left is Steve Galbraith. Steve, I first met when he came to Morgan Stanley as the chief equity strategist. And he is a very dynamic speaker. He has many experiences on multiple aspects of the micro, the macro. He was also an analyst in a number of sectors. And then he moved to a hedge fund to basically be the number 2 principal in the hedge fund. And so he's going to, again, have this perspective of being on the outside and then inside actually managing a business that actually deals with risk and uncertainty all the time, both from who they invest in and how they manage their own business. Okay, so that's the mix that's actually sitting here, and I'm going to pass it on now to Neal. They're going to sit at their tables.
Thanks, Trevor. Well, as Trevor said, I arrived at Morgan Stanley in 1982 to start a commodity business. And the interesting dilemma for me is, how do you start a business that doesn't naturally belong in a securities business? How do you make that work and operate? And at the end of the day, how do you make sure you don't lose any money? And that was the dilemma I faced as a 27-year-old with 3 years out of business school. And we thought about it, and we looked at the different risks that we could take. And you can see that in commodities, you're dealing with naturally very inherently volatile markets. And the idea was, could we do something to dampen that volatility, to take some of the risk out of that business? And as our business model evolved over time, one of the things we came to realize is that you can't be a real participant in the business unless you're really involved in the day-to-day activity. And one of the best ways of doing that was through asset ownership or asset control. And what we found out is by positioning ourselves in the business appropriately, being in the middle of information flow, we could effectively reduce the cost of the tails in our business, reduce the cost of our business risk. And I'm going to go through a couple of examples of things that I have done in the past. So these aren't examples of things that could be done or would be done, but examples of things that have been done within the context of a commodity business. And now you take that thought process and make it a little bit robust and gravitate it more to a sales and trading environment. What I'm going to avoid doing is reviewing the dynamics on a trading floor. That's for others to do at another point in time. But really start out with what I view as a very interesting opportunity to gather information flow. All right, so we're going with the electricity one first. If some of you are familiar with electricity or power trading, it was a great opportunity. It has been a great opportunity. And some of you are also familiar with a company called TXU, a big leverage buyout in the space. We can talk a little bit about that, but really about owning assets and owning ownership and what it really involves. So from my perspective, it's really about decomposing real optionality. So if you look at a power plant or an activity the way that I do it, what you're trying to do is extract the real options. It's not about being long or short, but trying to value the optionality. So you look at fuel opportunities, whether it's coal, natural gas, diesel, hydro, or even nuclear. You look at capacity. Capacity in power plants can be sold. Transmission, yet another commodity that can be valued. The electricity itself, and then clearly areas such as storage. A lot of people are talking about things like batteries today. In the example I give is really pump storage, where you take off-peak electricity and you move it uphill, and then you actually release water through a dam and create power during a peak process. But what this really was about was valuing options and collecting information. So once you have that information and you embed it into your business, you become part of the information flow in what's happening on a day-to-day basis. It's one thing to look at a screen. It's one thing to try to anticipate what's going on in a marketplace. It's another thing to actually be a participant in the business and have people calling you, setting prices, and being an important part of a regional flow. I think one of the key issues that we've always had is, how do you really value real options in the context of the things that I've done without great transparency and price deck. I think that goes to one of the things that Trevor is saying, that sometimes in businesses like this, you really just have to go with your gut. There's no certainty. There may be no price deck, but you understand if you're buying an asset and people are looking at it in the sort of the plain vanilla context, if you're able to decompose all the particular opportunities within an asset class or within an asset, as I've done here, environmental credits, electricity, transmission, storage, financing capacity, and fuel optionality, we're able to create significant value. And that significant value also becomes the key to the information flow that gets embedded in a trading floor. I think the other example that I would use is really revolves around the ownership of oil and oil reserves. And I think this is it's interesting today because if you look actually in today's Wall Street Journal, they have an article, it's either Chevron or Conoco, that now finds the Permian Basin assets, those are assets located primarily in Texas, as being very, very interesting. When you really look at what happens in a very simple oil-producing activity located right in the U.S., proven producing reserves that have been operating for over 30 years, what it really provides is a set of opportunities for people to exploit. And some of those that we talk about really are the cost of power. It's something that's very hedgeable and very, very manageable. The quality of the operator and the understanding of the geological formations. Risk management, which is in many cases risk management of cash flows. Storage, which in itself is an option. So one of the things I was also involved in is buying the 6th largest pipeline and storage activity in the U.S. In markets that are contango, this becomes very, very valuable, and this is something that's readily analyzable, and you can attach a value to it. Pipelines, shipping oil, whether it's in pipeline or truck activities, and then reserve recoveries, and that's largely based on technology and prices. But again, it's covering the information flow that really evolves in the asset ownership that I found most valuable in developing a business. Again, being a participant in the marketplace changes, I think, the terms of your uncertainty, and certainly changes the value that you can exploit as you move forward. I think that the real value in this activity is the ownership and control of assets over a period of time. I think the parallel that I would draw is really operating on a trading floor. So if you sit there today and you go to financial services conferences and you listen to the presenters, whether they're CFOs or head of trading or even presidents of banks, what they'll really talk about on a trading floor, what they want to tell you today is they're involved in the moving business, not the storage business. Everybody wants to be a flow monster in the context of making markets globally in most liquid products. The reality is what they're trying to do is exploit the trading floor as a set of options in the same way that I've defined an oil reservoir or a power plant. I think the area that people are most focused on today, the option that they're trying to exploit through the idea of being a flow monster, is harvesting and collecting information from clients. So if you look at the top, whether those clients are hedge funds, pension funds, long-onlys, institution, private wealth clients, they become the key to the information flow and source. There are other areas that you need to be great at in the business. And again, I think technology becomes an option. How much you want to spend on technology internally and externally also is very important in the marketplace. Internally, weaponizing your traders, providing the best formulas, providing the best analytics, and at the same time, there's a global turf war going on revolving around technology. Real estate on traders' spaces becomes extremely valuable. So how you attach a value to that and how you attach a value to clients becomes important. Market access, making sure that you can provide your clients access to markets and marketplaces globally, and how much is that really going to cost you to do that? Once you put that in place, it's largely a fixed cost, so you see a big rush between the top 8 to 12 firms to provide as much client access as possible to as many global markets. And then at the end of the day, you look at the client continuum. How do you want to reach out to your clients? Do you want to be low cost? Do you want to touch them technologically? Do you want to be full cost? Do you want to focus on bespoke products? In the same way, you look at the oil reserves, whether it's reserves in the ground, power, transmission, and storage. All these have real optionality value that are people that are trying to exploit in these marketplaces. I think the example that we give, the parallels are much the same. I mean, at the end of the day, I think for all these sales and trading business, whether it's a commodity business or whether it's a business focused on sales and trading, it's really trying to cut off the tails. How do you value that uncertainty? How do you really guide that in a direction that you find applicable to your business? And so a lot of that time and a lot of driving the business model is really involved in focusing on that type of uncertainty and doing that. I think the area that people have fallen on today is deepening the client base to offset risk. Understanding what your clients want to do, anticipating what they want to do, I think provides you a better context for markets and market making. I think business selection is also very important, understanding where you want to be in the future. If you look at all these businesses and how Wall Street's made its money over the last 20 years in 5-year clips, the top 5 businesses change every 5 years. So from a management perspective, there's optionality in making sure that if you're going to pick 10 businesses to put your money on, 7 out of those 10 are winners. You're never going to get 10 out of 10. But I think it's management's responsibility to make sure they guide their businesses to the places where there's the opportunity set, and hopefully they'll be right most of the time. I think the bottom line for me in developing these businesses is develop truly a business, not a business that's really involved in directional bets, but a business that's involved in a portfolio of risks and risk management. So I think that's the key to long-term success in any sales and trading business.
Thanks, Trevor. Probably the best assessment of how the world has changed since 2008 is that the hedge fund guy is the only one wearing a tie on the panel. And you'll kind of get that from my story. So what I'm going to tell you actually does combine to some extent Neal and Steve's stories, in the sense that a lot of what we try and do is manage the tail risk, and yet our core competency is really fundamental analysis of the GMs of the world. And so 2 seconds on Maverick Capital. We're about a $12 billion long, short, very plain vanilla equity hedge fund. We're one of the oldest hedge funds in the country, which is something of a tallest pygmy concept, in the sense that the failure rates in this industry are quite high, but we've been around since 1993. And so our story, this story is actually somewhat cautionary, and it really gets to what Trevor talks about in terms of thinking about uncertainty and risk, because we had executed really not flawlessly, because you're always making mistakes on a daily basis, but our expected returns and our expected risk in the portfolio really modeled out how we wanted it to for basically 15 years. And this is how the firm was set up. This was our core ethos. This is what we wanted to do. For the most part, our goal of the firm was to preserve and grow capital. And we did this by having a balance of long and short securities in a diversified fashion, meaning we didn't make big bets on the market. So we were always running about 50% net exposure to the market. We'd never have the whole portfolio short internet stocks and long commodities. We always had a balance by region and by industry in terms of the portfolio the management. And so what that meant was our success or failure really was going to be driven by stock selection, which we felt was something we could control, as opposed to what we couldn't control, which was market risk. We invest, again, in plain vanilla stuff, so it tended to be bigger cap stocks, and our edge, such as it was intensive fundamental research. And we really do, for those of you who have been involved, and Grisky can really speak to this, everyone claims to be a long-term investor. No one is. I mean, really, if you actually look at the data, the turnover in the market the holding period of the market is well less than a year now. It's actually about 7 months. That's the average holding period for a stock, which is pretty extraordinary. Ours actually, in terms of our core positions, is 3 to 4 years. So I would actually argue that that's longer term, at least, and bordering on long term. So we really do try and take a longer view. So given that we've identified, or at least we thought we identified, the chief risk to our business model was security selection, we then wanted to make sure we followed other procedures to mitigate some of that risk. So we are diversified, as I mentioned before. We do have position limits as well. So not only are we diversified, our biggest long position would be about 5% of NAV. So not a crazy concentrated portfolio, certainly versus some other deep value guys. We had and have an incredibly liquid book. The median trading volume in our portfolio is about a day and a half. That's a very, very liquid book. That's very different than, say, a Warren Buffett or someone who runs a very concentrated book. So we have a very liquid book, and we weren't and aren't crazy leveraged. And so the way we configured our entire business actually is quite unique in hedge fund land. We have a very large and robust analytic staff. We have about 50 investment professionals. And if you look at the typical hedge fund, that's not the case. It's usually a rock star portfolio manager and 8 or 9 other folks that are managing the portfolio. We actually have a very low investment position to professional ratio. It's probably among the lowest in the industry. Now, you could argue that's good or bad. Maybe you're diluting the talent if you have this rock star PM. On the other hand, we think If our analysts know the positions better than anyone in the world, we should be in a good position to assess the risk reward of that individual position. And so, putting the rubber to the road and getting to Neal's point, we thought we were actually pretty smart. And if you look at the distribution of our returns, and this is from 1993 to the end of 2007, we did precisely what Neal said. We cut off the tails, particularly the left tails. And you can see the distribution of our returns on a daily basis was very much moved towards the center and towards the right. And that has all kinds of positive implications. On a day-to-day basis, and don't minimize this, on a day-to-day basis, it means your hair's not on fire. It means you're not having that minus 3% or 4% day that can create all kinds of dysfunction in the investment process. And in terms of client interaction, in terms of everything, this is a really terrific model. And so over the life of our firm, even with what I'm going to tell you, we've basically generated about twice the returns of the market with half the volatility. If we can do that over the long haul, we'll have a lot of happy investors. So everything's sailing along pretty well. From 93 to 2007, we had never had a loss-making year. And that includes 00, 01, 02, when you had really bad years in the market. We didn't have a loss-making period when long-term capital imploded. And going into September of 2008, we were actually up probably 1.5% when the market was down double digits. So again, we thought pretty much the way we'd configured the business, run the business forever, was totally the right way, and we were feeling quite good going into September. And then the world imploded. As I said, we had never had a loss-making year in 15 years. Our core fund was down more than 10%. We had never had anything near that. Only 5 months out of the prior several hundred had we ever been down greater than 5%. It was more than 2x our worst down month ever, our worst long performance ever, and 6 of the 7 worst trading days in the history of the firm occurred in a 5-week period in September. And to put a finer point on it, this is a busy slide, but it really articulates how really ugly it got for us. And again, nothing changed. We weren't net long huge. We were probably 40% net long. We had all that different. Everything I told you before was what we had going into September. And as you can see, going into September, we were doing well. And then you can see how 2008 would have happened except for this weird 6-week period in September. There was a 6-week period, late August into October, where our portfolio just ran amok. It behaved completely unlike it had in the prior 15 years. And nothing changed in the way we ran the business. Nothing changed at all. But something happened in that period. And it was a risk that we completely had never thought about. And it was an uncertainty, frankly, that we couldn't even conceptualize. And what happened was the following. All around the world, in response to the Lehman issues and other stuff, regulators banned shorting. And initially it was for financial services companies alone, but then you had all these wonderful companies like GM claim that they were financial services companies. You had Sears Holding claim it was a financial services company, and you may guess we were short a number of these companies going into this period. And what happened was our long portfolio tanked, and in fact performed way worse than we would have expected. But our short portfolio that had a massive concentration in securities that were subsequently starting to be banned in terms of shorting actually performed well, which meant it performed terribly for us. And going into this period, so talking about risk and uncertainty, how you manage it, all these regulators actually gave you several days heads up, usually about a week, saying next week you're no longer going to be allowed to short for an unspecified period of time. So the risk committee, which is me and Lee, and we got together with a couple other the senior guys in the firm, and we basically made the following judgment. The regulators are telling you you're about to have an extraordinarily scarce resource, i.e. shorting. So in our minds, when something's scarce, you want to take it up. In other words, you want to be able to affect that, because pretty soon you're not going to have any ability to do it. And you are going to have an ability to cover, right? So we knew you could do that. You just couldn't add incremental shorts. So we did what we thought was actually logical. You're being told something's going to be a scarce resource. Press your shorts going into this, right? You're not going to be able to do this for an unknown period of time. But effectively what we did is we pressed our problem, right? So as these things were rolling out, we're pressing and we're building the short book, which in theory would have helped us because the markets are collapsing. The problem is our stocks aren't collapsing. They're being held up kind of artificially in our minds by this weird ban. And so the happy result, and why I literally did not sleep a single day in September of 2008, was this. So think about Neal's concept of truncating the tails, and think about our prior return stream, and look what happened. I mean, just completely out of the realm of anything we had experienced over a long period of time, right? In a very consistent, predictable pattern where we think we've kind of identified all the risks. So that's just looking at how the fund did, which is atrociously. And then this is looking at the long-short spread. This is our bread and butter, right? Our model is we want our shorts to go down more than our longs. We're market agnostic for the most part. We want to capture that spread. And look how god-awful that is. And again, what an outlier versus history. And then you can see we had disastrous results on the long side. I apologize that the short alpha slide, or negative alpha in this case, is even more revealing, but that too was part of the problem. And so what happened was basically in September of 2008, and again, it's a 6-week period, but so it's a little bit on each side, our longs declined more than our shorts in every region, in every industry, and in 17 out of 21 trading days. And obviously it was the first time in our history we experienced anything even remotely like that. And so stepping back, you had this firm that had an incredible track record of very consistent success and frankly risk management. And then in that, and we had historically focused on the stuff that every hedge fund focused on: market risk, leverage, stock selection, geographic risk, style risk, liquidity risk. But what we hadn't really focused on were the things that we now focus on. We have to look at crowded trades. So one of the things we found as part of this crisis is we all owned the same stuff. So a lot of the hedge fund community own the same things on the long side. And if Maverick's business is in great shape, but your counterparts are getting liquidated, that puts immense incremental pressure on your long book. You had prime brokers that were suddenly under attack. Lehman fails. Well, that means everyone pulls their balances out of Lehman. Well, that creates a funkiness in the short market because you have to go out and physically reborrow shorts to put the shorts on. Oh, but wait, there's a short ban in effect. So there were all these artificial things that came out of that led us to totally reassess risk. We look at all the stuff we used to, in other words, all the financial things, but now we spend a much, much more greater time with regulators, with politicians. We're doing this all over the world. We have a much better sense of what overall hedge fund leverage is in the market. It's not just our leverage that matters, it's the system's leverage. We have a much better, we've always had a diversified prime brokerage book. We always had 6 or 7 prime brokers, but we did it for commercial reasons as much as risk management reasons. We used it such that we could have leverage over Goldman or UBS to make sure we got the best terms. Now we think of it even more so of counterparty risk. And we now have almost all of, in fact we do, all of our prime brokers are banks. So we know that they have a Fed access to it. So I'll kind of talk to all these. And so summing up, you know, I still think our model is correct, right? So our core competency is there really is no substitute for knowing what you own. And so that part of our business hasn't changed. We still have this overlay of trying to know the companies better, so knowing the GMs better. But what really has come out of this period, for me anyways, is you can't be static in your risk management procedures. Even with this long history of success and mitigating risk, and so our whole approach to risk in terms of the soft issues, to Trevor's point, the unquantifiable stuff. I can look at the beta of the portfolio. I can look at the liquidity of the portfolio. That's all very measurable, at least backward looking. You don't necessarily know how it's going to look forward looking. But these softer risk issues, these regulatory issues, we're just spending an immense amount of time on. And so that's the case.
Excellent. So it's now up to anyone in the audience. If you have any questions, there are, I'm sure, hopefully some questions out there. Otherwise, or anyone on the panel, you want to add anything, any questions?
Let me ask Steve a question. Are you encompassing macro hedges in your book now?
Yeah, so if you look at how we've spoke to our investors over the prior 15 years, we always said we're going to lose or make money on security selection. But one of the things we found is out of 08, obviously, it didn't always work. So yes, we are, to answer this question bluntly, we're very active in the CDS market now, especially at the sovereign level. So if you look at things like what's going on in Portugal, Greece, Spain, so on and so forth. And in fact, Neal, we brought in a team. We've hired actually a student of mine at Columbia, Trevor, who had gone to work with Seth Klarman, who's really one of the world-class managers. He's come in, and we've built out a team now. I'm a little leery, right? Because it's a reactive type of response, and I don't think it's ever going to be our core competency. And so I wouldn't sell this as Maverick's now this great macro hedge fund, but as the rules change, you got to change the business, and we have.
Bob Hurst.
I guess this is to probably Steve and Galbraith and Neal, but listening to
So I'm going to
out of regulation and out of just something that the earthquake can happen at any time.
So I'm going to repeat the questions so that it's available for everybody who didn't hear what Bob said. And if I'm misstated, please correct me. But the essence was to Steve Galbraith and Neal primarily, is given Dodd-Frank, does that, and related regulations around the world, does that actually help to bring your ability to manage these uncertainties and risks closer, or has it maybe not changed it that much at all? Is that a fair summary?
So first of all, I'm probably the only human being on the planet that actually tried to read the Dodd-Frank bill. And
Charlie Calameris did too, actually, in the audience.
It's sitting in my office, and it's like this. I mean, it's just unbelievable. My poor assistant had to, print it all out. And to be honest, I don't know the impact of Dodd-Frank on our business. I really can't figure it out because I'm not entirely sure they know how it's all going to morph out. But what is clear to me is the main lesson we've learned is that the regulators and the powers that be are very reactive. So to answer your question bluntly, yes, I do believe now, mainly because we've had some global healing of the economy, therefore you're less apt to have reactive regulation and so forth, that we're going to start seeing lower correlations in the market, and therefore we can get back to our business. But I think you're spot on right that the next earthquake is going to happen, and it's probably something that none of us are thinking about right now. And so that's kind of the way we think about your point. And then lastly, the one thing we are very happy about Dodd-Frank is that Goldman Sachs can no longer prop trade. Because which I didn't really talk about here, but it became very clear to us that we may have been a client of Goldman Sachs, but they were a big competitor of us. And to a lesser extent, UBS and some of the other guys. I mean, there was billions of dollars of capital and getting to Neal's point, and I'd be interested in his response, and I'll shut up, because the concept that he said about getting client information and in order to mitigate the tails, I was always a little skeptical about how they used the information that might have been available in the market. So anyway.
Anyway, yeah, Dodd-Frank and Basel 2.5, 3. Next to the research analyst settlement, those will cost the consumer a lot of money in the future. We've got the elephant in the room, and Steve ended with it. I'll take it there is nobody knows. Okay, so this whole idea of being this flow monster, which everybody talks about, is not predicated on making money crossing spreads in the marketplace, but being the center of information flow and activity. I think the broker-dealer community is still waiting for the answer. Buying a security, buying U.S. government bonds in anticipation of an auction. Is that inbounds or out of bounds? Making markets to clients. Is that inbounds or out of bounds? I think that's the question. If there's no value to that information flow as a result of Dodd-Frank, I think you'll see increasing changes in the behavior. Listen, you've already seen almost every major bank talk about huge reductions in its ROE. They're now talking about a range anywhere from, let's call it 12 to 17% on the wide. You're not going to see people knocking the lights out in the mid 20s or 30% anymore as a result of this regulatory thing. The flip side of it is my fear is that it will take liquidity out of the marketplace. Pension funds that want to adjust their portfolios and come in and use derivatives. Will dealers be open to that? Will they be able to do it? Or will they have to go into the cash marketplace, sell bonds and sell equities every time they want to do something, as opposed to making adjustments through the swaps market? That could be off the table. Going back to the commodity business, consumers and producers of commodities that want access to risk management and hedging, people that want to lock in, airlines that want to lock in the price of jet fuel, an automotive company that wants to lock in its metal prices over a term. The cost of that risk management is going to go up significantly to all those companies. Basel 2.5 and Basel 3 and its implementation. The lack of a level playing field. Regulators across the world are defining for institutions on their own what their balance sheet, risk-weighted assets, loss-adjusted stress, cost of funds are. I think there needs to be more transparency in the marketplace. They're already collecting this information. They're already validating the stress tests. I think that they should make that information available and allow analysts to benchmark it. The secret sauce is no longer how you stress test your business. The secret sauce is your brand and how you face off with your marketplace and your clients. Having that information out there, I don't think will disadvantage any financial institution. But my view is that the sloppy implementation of Dodd-Frank and potentially Basel 2.5 and Basel 3 will net cost the consumer, whether it's institutional consumer or the individual, because liquidity will be taken out of these marketplaces. And let's not talk about the shadow banking system, where you can find hedge funds making markets and swap markets, and they would be totally unregulated under the current regime.
So Kathy Strand, I think, had a question. You need to speak up a little bit, or we can get you a mic. Okay, so the question that Kathy asked was, in managing the risks of a portfolio like Steve Galbraith does the fact that General Motors is going to try to hedge its metals risk that Neal was alluding to, does that actually help or hurt you? And I'm going to just add a piece to that, is you talked about the uncertainty in your business. How do you assess the uncertainty in your clients at the same time, which is related to that question?
It's a very tricky question because we're obviously running long and short. So based on experience, we have found that, well, two observations. Number one, if the business risk is very high, it will never be a large, long position, even if we think it's a very attractive company. So think like a biotech company where we have a strong view that the science is going to lead to an approval, so on and so forth. We will size that down appropriately. So we are very focused on business risk. But your question is intriguing because over time, we've actually made a ton of money on the short side from companies that claim to be able to hedge or manage their risk at levels that we felt were way in excess of what the actual business risk of that business would have been. So think AIG, for instance. Think Enron. Think our biggest short winners were all these businesses where, look, the world is really uncertain. And if you see this return stream that seems Bernie Madoff-esque, you should be asking a lot of questions. So if Grisky suddenly starts giving me this great, wonderful earnings stream from GM, we're going to be short the crap out of the stock. Because there's no way that mimics reality, even if he is a genius at hedging. So I think it's a great question because we spend a lot of time on that trying to figure out, and then it also gets into whether we have management's credibility or not and all the other stuff.
You want to comment at all, Steve, from your side?
Thought about it, but I'm worried.
Well, so I'll ask you the question in the context. Oh, go ahead.
I mean, it's something I've actually spent a lot of time looking into and thinking about. So if you're General Motors, you're Pepsi, you're a variety of your Delta Airlines. General Motors is in the business of making cars. Are they in the business of speculating in the copper market, the aluminum market? Or would you expect them to want to take out as many of those risks as possible out of their business? What are you buying their security for? Because they're a great marketing company or manufacturing company, or they're taking a speculative interest? If you're if you're Pepsi, you buy cans, okay? Should they have any expertise in buying and making cans, or again, are they a marketing company? The more profit they can generate, the more they can drive through their marketing, the more sales they're going to have, the more profitability they're going to make. So you have to decide which ones. I think the classic example of this, and the one that's a pure play, and you should probably start out with that, your Barrick Gold. That's a famous case because it's a company that was one of the most voracious hedgers of gold. In fact, if you go back and look at their annual reports dating probably the late 90s into the early 2000s, they will tell you they sold their gold at $80 above the market average on an annual basis. And what did people do? They trashed their stock. Their stock didn't take off until Peter Monk came around and said, buy the hedges back.
I guess if I can add, so we don't manage risk by buying. We'll protect against tails like these guys do, which is, by the way, a change in philosophy at GM. GM's had billion-dollar currency hits before. And we are not speculators now, but the way we would try to manage these risks are, instead of buying futures on palladium, let's see if we could, or platinum, let's see if we can figure out engineering solutions to take platinum out of the car. Or more, instead of hedging currencies, let's see if we could do more building where we sell to take that risk off the table. So we're sort of getting out of the business of managing risk by buying hedging futures or what have you, and more towards let's try and lower the risk profile of the entire business.
But all that goes back to doing what your core competency is.
Exactly right.
But I'm going to add one caveat is, even if they did, I would ask anybody to suggest, and there are many people who've been in business here, how would you even know on the outside? I mean, so Galbraith's talking about, we manage, but most people, frankly, have no idea of what's going on, and I don't know how you possibly could.
But you could. There's some ways to measure. There were some financial statements. I remember, I think it was Peugeot in the old days had huge yen. They bought huge yen exposure and way more than the vehicles they sold in Japan.
Would we ever get to know if you had hedged your copper, your palladium,
No. You would only know it if it blew up.
Right.
But you would know if I'm selling more cars where I build them. You would know that.
Right. All right, next question. So the question is, and actually all three could answer this, although it was addressed to Neal, is how do you actually measure and estimate the tail risk that you try to manage?
Well, there were two kinds of tail risks we looked at. And one we would always avoid. This is not do something, in many cases, some of you may laugh at this, that would effectively put the entire business at risk. That kind of risk was off the table. In terms of managing, trying to quantify the other tail risk, and a lot of it goes back to what Trevor said. We didn't have beyond looking at stress tests, which were highly flawed and based largely on the scenarios we had, we didn't have a highly sophisticated way of doing it. But we knew there were certain types of scenarios, certain price paths that would be detrimental to our business. So effectively, by asset ownership and taking those real options, effectively being long the gamma of those options, that would help mitigate the tails in the business. Was it something we could put a number on? We tried many times. We looked at all the books. We looked at all the academic literature. I can give you some real cases, but the answer is being long the optionality, being long the gamma through asset ownership was we decided was our best protection against some of the tail risks, and avoiding the risk of ruin in all cases.
Do either of you want to, either of the Steves want to comment on that?
No, we just call Neal Chair and say, what do you think about, how do we
Anybody on the right here? I've been looking on the left. Scott.
Question for Steve Galbraith. In September 2008, what sort of discussions did you have around the liquidity that you had offered to clients at the time?
So the question that Scott asked is, around September 2008, what kind of discussions did you have around the liquidity you offered your clients? Is that?
That was the industry's real black eye, as many of you know, coming out of it. And one of the things that I think investors didn't assess in terms of a risk of their investing in hedge funds was what I'll call documentation risk, because the documents are so one-sided in favor of the management company against the investor that effectively you could put up gates, which many of our competitors did, and we did not. And in large part, we're very fortunate to have been old. As I said, 80% of our capital has been with us for a decade or more. So I can tell you, I think if we had another September of 2008, I think even that capital would have fled. But because we had behaved well through the prior bad cycles, people were tending to stay with us. But what we did do in response, that in hindsight proved to be a very bad decision, we massively delevered to prepare for potential liquidity if we did get calls and people started redeeming. So we took our gross leverage, which had been probably running at, say, 225%, down to about 120. So we massively delevered, and naturally, once the short ban was lifted, even though the markets acted badly still, our long-short spread went crazy to the upside, and so we lost that upside. So we did respond to the threat or fear of liquidity and redemptions, but fortunately they didn't come.
So I have a question for Steve Grisky. I actually have two related questions. When you were an analyst and you were trying to look at General Motors and others, how did you feel about, or knowing what you know today, what would you like to have done differently potentially, or what is it that you'd like to know more of in terms of being able to assess these uncertainties? And related to that is, if you're now in the business of having to make forecasts. In the auto industry, your design starts 4 or 5 years before you deliver, and lots of competition, uncertain demand, etc. How do you sort of try to bridge all those? And what is it that you would love to have that maybe people in this audience could help to think through over time to help provide for you?
So in hindsight, really there's probably 5 issues that sort of drive the business, right? Demand, supply, price, cost, maybe mix. We knew a lot of that on the outside. We didn't know necessarily the profitability impact of a car versus a truck, which is something I would have liked to have known, because that really caught the company. But the other stuff you sort of had at a high level. Now, internally, there is a tendency to overanalyze things. And that is you're still not going to, there's competition. You try and make an assessment of what they're going to have and where they're going versus where you're going and try and get there. It's not going to be perfect, and your tendency to overanalyze. When we were buying AmeriCredit, which is a credit company, a lot of old GM came back and said, tell me exactly how many more cars I'm going to sell if I buy this thing. The answer is, I don't know exactly. I know it's more. And even internally, we're dealing with partial information here, and you're making bets around it. So I sit on the outside, and I think it's good for your business because you can analyze the big pieces of a company, the big drivers of a company, without a lot of. You don't need a lot more information than you get. You got to be honest with yourself about it, and frequently, I think the biggest trouble on the outside we used to get into is you get emotional about these things, and you get emotionally attached to these things, and you've had a buy in it so long you don't want to take it off, and frankly, it's the same thing inside. You get emotionally attached. I like this car. I really want this thing to go out and blah, blah, blah. Well, competition's running right over you, and it's completely wrong for the market, but so it's about unemotional and making decisions with 80% of the facts instead of 100%. And if you try for 100%, you're never going to get there.
Great. Charles.
Question for the two Steves. Neal talked about real options and thinking about things as a portfolio of real options. In your business, do you ever think about things explicitly as real options? Do real options type analysis?
So the question for anyone who didn't hear Charles, although he spoke very robustly, was do the two Steves think about the real options that Neal alluded to? Explicitly.
I think we think about optionality in a number of things. If we're going to partner with somebody to produce a vehicle as opposed to do it ourselves, do we get optionality around that? We started a venture capital fund where we will actually make investments around future technologies, sort of cheap R&D, where you're basically buy options around certain technologies that you may not need right away. We try not to, there's no specific financial number around it, like we're not going to make $1 billion bet on a certain technology that's pure optionality. We need some foundation for some of that, but I would say we're trying to, the newer people inside GM are trying to get the company to think more about optionality and maybe sort of cheap ways of buying into other technology or diversifying risk, things like that.
And it's interesting. I mean, we're not anywhere near as evolved as Neal certainly was at Morgan Stanley, but where we are making those types of investments is interestingly not in the portfolio, but in the business. And by that I mean we've started up, for instance, Maverick embedded in it has a fund-to-funds business where we're investing in other hedge funds. And I can't tell you how helpful that's been to me in managing our portfolio because we get insight into their business as to what they're doing. We've also are noodling about setting up a seeding operation for other hedge funds. We've, like Steve, have set up a VC arm that is invested in companies that compete with many of the companies in our portfolio. So it gives us a much more holistic view of what the future of that industry might look like. So I think it is kind of interesting that in the portfolio per se, we expect our companies to do what Steve's company is doing, and then we're trying to deploy that kind of tactic in the management of the business or the management company as opposed to the portfolio.
Mark Lang, and then Don Chu, and then Jesse. So Mark's question is around managing the transaction costs and liquidity and how you think about them when you've got this chaos going on. And I think Neal can actually also speak about that in a slightly different context, but I think it's first to Galbraith.
Well, three observations. We focus, I would argue, too much on liquidity in the sense that this is, for those of you familiar with the hedge fund industry, there was a really legendary manager named Julian Robertson, And my firm, as well as a bunch of others, are known as Tiger Cubs. He ran Tiger Management. And I think every single one of those Tiger Cubs had branded on its brain U.S. Air. And if you're not familiar with this story, Julian had owned 20-something% of U.S. Air and was like 80 days trading volume in it. And the market, U.S. Air imploded, and other things happened at Tiger, but it was a serious part of Tiger's issues as it ran down. And so, as I mentioned earlier, Maverick's portfolio at a day-and-a-half liquidity, median though, which is an important point, is extraordinarily liquid by almost any standards. That said, what we tend to do is getting to kind of optionality type names or flyers or emerging markets type stuff. We will own illiquid positions in those, but they tend to be very small. They'll be like 70 basis point positions or something like that, where if we couldn't almost ever get out of it, it wouldn't permanently impair the business. And then the last thing that we always take great comfort in, which is somewhat unique to Maverick, is almost 20% of the capital is ours. So it really allows us, I think, to take a slightly longer view than many other in the industry, in the sense that we can really say, okay, we're eating what we cook, and it really, we can take the longer view. Last point as to with respect to 2008, the triage that occurred, frankly, in our fears on liquidity were much more driven actually by our counterparties than by us. In other words, we felt we had this robust liquid book, and we did. We could have gotten out of it. But we actually had 2 or 3 of our primes fail to deliver on the other side. And that's where you're starting to realize, oh my gosh, this liquidity train, it's kind of like Grisky's comment about suppliers, where you have to look at the next layer. If they're not coming up with the cash, how are we going to come up with the cash if someone is going to redeem? And that was why we really took our leverage way, way down to get more liquid.
You want to comment, Bill?
I think that it's absolutely clear post 2007, 2008, the banks are much more focused today on capital and how they're charging capital down to the desk level, which includes, sort of that cost of liquidity. At the end of the day, it's the amount of capital that you provide traders, which really, at the end of the day, will drive their P&L, and also drives compensation. One thing we didn't talk about, when you come full circle in an environment where ROEs are down significantly, I mean, one of the key variables to the stakeholders will be, compensation, and that needs to be better determined on the risk capital that's being used and liquidity provided.
So that's going to be a big part of the discussion tomorrow morning as well. So Charlie's going to lead a lot of that. So Don Chu, you had a question.
Yeah, I have a question about the profitability of corporate energy trading operations. They own assets and they have these information flows. It strikes me that most of those don't really play an option game. They tend to take longs and shorts and go with the gamble. There's a study by John Parsons at MIT that looks at Constellation and a bunch of other energy traders and finds that their rates of profitability are really quite low. So
They sold their trading arm.
okay.
So,
It was really low.
Are these profits really based on better information, or are they just taking these wild bets and not hedging them and then ending up losing money on a risk-adjusted basis over time?
so Don's question, which I'm going to summarize, is are the businesses that have essentially internal trading businesses, and he is alluding in the energy trading, which is Neal's specialty, but it could be any business, frankly. Do they actually are they really just speculative, or are they actually making money? And you could think about it in the debate that sort of got started but never took place between Steve and Neal, is who actually has access to this flow of information and how are they using it? You want to answer?
The gentleman, I haven't read the paper, but my anecdotal evidence, my knowledge of what happened when power trading companies, energy trading companies, oil trading companies all set up trading desks. Most of them did not produce the returns that management expected, and most of those desks no longer exist today. I think being arm's length and having to start a business sort of de novo the way that I went about it, forces you to have the pressure and the discipline, thinking just because you sit at a major oil company you're going to make money is illusionary unless you really tie it together, and none of them really, I think, achieve that.
Can you take your insights and transfer them to these companies and show them how to do it?
For how much? I think one of the interesting things when we get back to information barriers, I started when it was sort of the wild, wild west, and the way you treated information in a securities business was different than a commodity trading business. I think the information barriers between different parts of companies are becoming greater, and I think it'll be more difficult. But I think the answer is, in theory, if you have the right mentality and the right people, there's no reason why you can't do that. You can't imagine a large global refiner today doesn't have better information than somebody sitting in front of a screen. But for whatever reason, it hasn't happened.
Okay, so we've got.
Let me just come back to one other point I'd like to make. So if you look at some of the large commodity trading companies today, they no longer call themselves commodity trading companies. They're logistics companies. They're all downplaying the fact that they're really involved in speculative markets. You look at a company like Noble, you flip through their annual report, you'll see trains, rail cars, boats, ships, and maybe a hunk of coal somewhere. It'll be interesting to see what happens when Glencore eventually does its much perceived IPO, how they build themselves. But my guess is they'll talk to you about the fact that they're a commodity marketing company. Not a company that's really directionally placing bets.
So Neal did accounting in his undergraduate. He actually is one of the other people in the room who actually enjoys reading 10Ks. Jesse.
We've all experienced a very rough time last few years in the markets. And boards are clearly paying a lot more attention to risk management now. What about the investors? Are they going to demand more disclosure on risk management procedures for corporations going forward?
So the question is that given the experiences that everyone's had, are investors actually going to demand more? And I guess the question can go to both Steves. Steve Grisky, are you seeing that investors are approaching you in a different way to what you used to do? And then maybe Steve Galbraith, you can comment on it. And actually anybody in the audience, someone like Alistair Wilson could maybe comment on that too.
I would say the investors should demand more disclosure around this. Whether they'll get it or not, I'm not sure. I think investors who focus on the long term, like Steve here, the stuff you're seeing today, there's usually the flavor of the day that everybody gets also. Today's flavor is Japan. A couple years ago it was currency. I mean, these things move, and a lot of investors tend to focus on sort of the short-term issue, but there are long-term risks and risk management that guys like him will be more interested in going forward.
This sounds crazy, but we actually hope they get less information in the sense that our whole model is built about us getting that information, Jesse. So it's a strange answer to your question, but I also think that the other thing to consider is oftentimes investors ask for the wrong type of stuff that leads to dysfunction in the system, i.e. quarterly type data, or same-store sales at a retailer is the classic one, right, where everyone wanted that stuff, and it led the stocks to have incredible volatility, crazy turnover in the shares, and now corporations are finally, fewer and fewer retailers are now giving same-store sales, which I think is kind of smart. I mean, it's not necessarily going to help you make a long-term investment in Kohl's or Macy's or whatever.
And it's interesting, in the auto industry, you can actually spend the money and get what's produced or even forecasted to be produced in every factory in the United States for the next 24 months. So if you're willing to pay and you're willing to process it, the amount of information that's actually available outside of financial statements is truly shocking. It's not necessarily risk-related, but there we can assess it. Charlie Calameros, and then we're going to take a break.
It's a short question, just building on Don's question, because I was struck that in your comments, Neal, you said that having some ownership or control involvement really helped in information synergy between running the trading business and running it operationally, having your foot in the operations. But then it seems like it's not a two-way street. You can't, it sounds like the conversation you had with Don was saying, well, but if you start in the operations and ownership business, it's a lot harder to move in to take advantage of those synergies coming from that direction. Is that putting words in your mouth?
So,
No, I think
Can
the
you just
bottom
repeat
line,
it?
I think it's all in the execution.
so the question that Charlie was saying is, if you listen to what Neal was saying, he was saying how much advantage there was to actually owning the physical in terms of facilitating the business profitability. And yet, when you started with the physical, it didn't seem to work the same way. How do you put these two things
I
together?
think it's purely behavioral. It's only, I mean, that's the only thing I can come up with. I watched this over many, many years. I watched people attempt it. I watched them all go out of business, and I think it was behavioral, but the people they hired, the ethics they had, the course they chartered for themselves.
They set them up as profit centers, right? And doesn't an energy company take and say, you're a profit center? And
Yeah.
They create a stream, and then they say, we want to be valued on that stream. That becomes a permanent part of our earnings base, and so you create all the wrong incentives.
It didn't work. Behavioral. Yeah.
It's predictable that that's not going to work.
It didn't work.
Blow up at some
So-
technology.
Yeah. So Don was just indicating how that it sort of didn't get integrated in the right way, and the incentives were set up, and it was separate profit centers, so that's why it couldn't
No
compete.
risk management contained.
Time for one more question. Jim Whalen.
Yeah, I just want to follow up a little bit on Jesse's question and direct it to Neal. Steve Grisky. Earlier you said the board now has a financial and risk committee or subcommittee,
Board has a finance and risk committee, yes.
and there's now a chief risk officer, and yet you replied that that investors probably wouldn't get the additional risk information that they think.
Oh, I don't know what they're going to get. I thought you were talking, Jesse, from a regulatory perspective, what is going to be demanded to be provided. But what's interesting is I don't know of any investor who's asked to speak with our chief risk officer.
But my question is going to be, is the firm or are firms in general, are you seeing firms being more forthcoming about risks that should be disclosed and that investors should be made aware of, beyond the almost vacuous boilerplate statements that get made about risk in decades?
So Jim's question, if I understand it, is are investors being more explicit, if you like, or looking for more?
So you're saying we have a list of top 25 risks. You're saying should we make that list public, or do? I would say if we made that list public, it wouldn't help you, because you could pick out the top. You probably couldn't pick out the top 25, but you could pick out the top 5, or maybe not this group, but someone who spends a lot of time on this. You could, but someone.
But by not disclosing it, you have no idea whether it will help us or not, or we.
So car truck profitability is high on that list. Okay, we talk about that all the time as something that's important to us, something we pay a lot of attention on. We disclose to investors what we worry about. What we worry about. There's all this risk section. Frankly, the risk section in the 10Ks are, I don't want to tell a group of accountants that they're a waste, but it's, it's got to be, there's better ways to do it than that. And when we communicate to the street, the question inevitably comes up, what do you worry about? And, there's 5 things that we worry most about. They change, by the way, but.
I'd echo what Steve says. And I sit on a couple corporate boards, and I would argue what's going on in the boardroom now is there's such risk aversion that there is this tendency, to your point, have this vacuous where you list every risk. And so it's completely unhelpful. And I think Steve is right that a sophisticated investor would know GM's top 20 risks, but where there's need for help.
Thanks for bailing me out on that.
But where there is need for help is maybe the quantification or the magnitude of those risks within the enterprise, right? And that's where there is, and again, where the boards I'm involved with, where we'll talk about this and like, okay, everyone knows that these are our 10 risks, but the people really know that this one risk is the game changer, Death Star risk. And that, I'm not sure, is always well articulated.
So I misspoke. We do have some extra time. So if there's, Peter just threw something at me and told me. So if there are other questions. Sorry, Steve, yeah.
Yes, I have a question for Steve. I'm sorry, the Galbraith. I apologize.
The gray-haired one.
Good one.
So, you talk about the sort of equities you're interested in investing in, and a lot of people, at least myself, think these are the hardest stocks to actually make arbitrage profits off of. Because you talk about big cap, highly liquid stocks. And so, a couple of things that I would like to know is, what do you think is the malfunction in the market that is allowing you to exploit this? What is the factor of your production function that allows you to exploit this? In particular, is it you have better information? Is it you have better people? Is it you have a particular way of dealing with data? And then where is this going? I mean, are you beginning to see more and more hedge funds doing what you do? Because this seems like, sort of the equities to go at. Now, maybe I'm misunderstanding your strategy, but this is what you find. I find this.
No,
But let me just, do you want to repeat the question, or do you want?
You can, because it was so long, I'll never get to it.
Okay, so I think that what Steve was asking, Steve Monahan was asking of Steve Galbraith, and actually I think Grisky and Neal could also allude to it if they want to, is it would seem that in the the large firms that are very liquid, very active, that you'd have efficient markets, and therefore there wouldn't be a lot of information that could be arbitraged to give you lots of profits. Yet that seems to be the strategy. Is it because you have better information, better people, or what is it that allows you to be so successful, and then is anything going to happen that's going to change it?
It actually is a great question, because if you actually looked at Maverick's strategy, because you hit on something that when I first joined the firm 7 or 8 years ago, as a frustrated non-academic, I looked at the return stream, and I almost said, these results are too good relative to my understanding of the opportunity set. Having twice the return with half the vol just seems crazy. But as I got involved in the business on this side, the 2 or 3 things that I'd argue are market structure related where we have an advantage are, number one, the time horizon thing. I actually think there is this concept of time horizon arbitrage, and as the fallout from Reg FD, you used to be able to make money on a very short-term basis because, frankly, the companies were disclosing stuff selectively, and there were firms that were advantaged, and you could trade around positions and make a ton of money. As that dissipated, the behavior didn't. So people still try and guess GM's quarter, which is a joke and completely unproductive. We actually did internal analysis of our results, and we found we lost money when we initiated positions trading around quarters. It was a disaster. And so this was one of the exercises I did when I came in, and I showed it to all the investment professionals. So we've changed our strategy. We are a much longer term investor, and it frankly has made us much more, we're a better firm now because of it. The second thing that, again, I'd argue is market structure related a little bit is the entire industry has become so fixated, at least on the long-only side, where the tracking error police run these firms. In other words, you have to look like some index. You can't deviate from the index because then you're putting our firm at risk. You'll get fired. There's not a single person at Maverick other than me who knows what GM's or GE's position is in the S&P 500 in terms of weighting. We don't care at all. So while we are kind of larger cap, it's not exclusively. I mean, we own some very funky stuff, and we're all over the place. And then the third thing that I think really does advantage us, although you could argue the magnitude, we are truly global in scope, and we can move the capital anywhere in the world. And so as EM really imploded this year, we put a bunch of dough into the emerging markets. And again, we have no fears about where it is in the index or anything like that, but we have boots on the ground in China, we have boots on the ground in Taiwan and India and all these places, and yet we're looking through it through this structural prism of industry expertise. I do think it really is advantaged versus many participants. We're not advantaged versus a Wellington Management or a Capri or people like that, but I do think it's a true advantage.
I would say, having been on a road show last fall, visiting a lot of investors in a short period of time, there is a huge discrepancy or diversity of how people look at it. The way there is the short-term fixation hasn't changed at all. It hasn't changed since I started being an analyst. Frankly, it's gotten worse. And I still think it exists today, and there's a lot of people who will not, they say they want to look long-term, but as Steve said, they will not look much past 3 or 6 months because they view, especially in these liquid names, their view is, I can always come back to it. I just want to step out of the way, I can always come back to it. So there's a huge discrepancy in how people look at things.
Krishna, and then I'll come around. Go ahead, Krishna.
Particularly the GM context, what is, now that you identify sort of unique risks, what is the availability of insurance? What's the availability and what is the limitation in the use of insurance?
Buying insurance, so to speak. Most of these risks we do not. The insurance is running your business better. The insurance is building where you sell. The insurance is taking weight or taking precious metals out of the cost of the car. That's the insurance is things any time of if we're going to buy currency insurance, it's we end up speculating, and that's not something we want to do. So we don't. Most of these risks that I look down here, you can't buy. You can't buy insurance on whether North Korea is going to invade South Korea at some point, right? You can limit production exposure in South Korea. You can limit it in North Korea too, I guess. So that's how we think about it.
Ed Swanson, you had a question?
Yeah, I was just going back to the information advantage that Maverick and some of the other companies might have. In the academic community, we have quite a few papers that have risk-adjusted trading strategies. Are these papers used to monitor them?
So the question is whether academic research on risk-adjusted trading strategies, would they be used or useful to people in the hedge fund community or the investment community?
Careful how you answer that here.
Complete waste of time. No. There's a cohort of investors to whom they're unbelievably interesting, and you guys probably know, like the Cliff Asnesses of the world. There are a bunch of folks that really have almost one leg in both academia and investment management, and we all read this stuff. But it's a fairly narrow group, and so to me, the interesting challenge from your perspective is how do you broaden distribution? Because I am an information junkie, and I do get all this stuff, and I try and really stay on top of the academic, but I would argue I am probably, not just this way, but I'm unusual. And so I do think there's an opportunity for folks to penetrate the investment management world far better. And whether that's getting involved with the CFA Institute folks or, I'm not sure exactly the best way of doing it, but there's a hardcore group of users that really value it and look for it. And then there's the opportunity set out there is the way I think about it.
Go ahead.
Steve mentioned quantification of business risk would be helpful. I'm just wondering if you could give us an example of one of the 5 major business risks or something high on the list, how you would go about quantifying it for the use of investors.
So the question is, given the perceived need or interest in some of these unidentified or unexplained risks, or one of the key risks, how could you or would you go about measuring and measuring?
So some of them you can measure. We produce 1 million units in Korea. If Korea gets disrupted, you can apply margin to it. If you look at oil risk or $100 oil risk, you don't know how much the mix will shift from more profitable to sort of less profitable smaller cars. You can make an assumption on what the profit differential is. We will not provide that because it's competitive information that we don't want to provide, but you can, you'll make an assessment. So a lot of this stuff we will measure internally We have risks. We understand internally. This Japan stuff you can't measure. I mean, you can run scenarios every 4 hours. They'll be different as you get more information. It's becoming, at some point, I'd say, at some point you will be able to measure it, but not right now. Other stuff we measure internally. Cars shift from cars to trucks. What's the profit differential and what's the impact every 1 point shift? What does that do? We measure that internally and we show it to people internally. It's just not something we would provide externally because there's competitive information around it.
So I have a question for Alistair, if you don't mind. Alistair Wilson is visiting us from London, and he's an auditor, senior auditor, who's experienced a company that's had some fairly significant uncertainties and risks. Is there, and I'm not asking you to identify the company or anything, unless you're comfortable with it, but how, from your perspective, would you see that information or information disclosures or some of the issues that are talked about here would have been helpful to both your client and or you? And Laurie's going to give you the microphone to see. And just while the microphone's going, Alistair, I tutored when he was studying in South Africa, and we've known each other for a long time.
Yeah, so if I talk complete nonsense, you can blame Trevor, because I mean, I don't think it would have made much difference at all. I mean, I think it's probably more interesting to look at the changes that have occurred, and I can only speak first of all in a European context, and secondly not in a financial services context and outside that. But I think in terms of the changes that we're observing in corporate Europe, I think that there is a danger that we're just going to get massive disclosure of every possible risk in the accounts, which isn't going to be very helpful. I know that there's already quite a lot of regulatory pressure on companies' disclosures of risks, and it'll be interesting to see how that pans out. In the UK, for example, the regulators actually put out a warning shot already to say we don't want companies just giving a laundry list of every risk that they can potentially think of. So it's going to be interesting to see how that pans out. But I'm not too sure that it's going to make a huge amount of difference one way or the other. I think the interesting things and quite an interesting comment about risk committees and chief risk officers. There's a big debate going on in Europe now as to whether companies should have risk committees and whether they should have chief risk officers. It's quite surprising how many companies don't, and that's a debate that's going on. In terms of demand for greater information about risk and so on, I think the demand is actually coming from boards generally, and from non-executive directors and audit committees more specifically. You can understand, obviously, they're concerned about their personal positions, but I think the pressure on management in terms of articulation and quantification of risk is coming from within boards, and there's a lot going on there. The catchphrase, of course, which I'm sure we're all familiar with, is high impact, low probability risk, and I'm aware of companies who are trying to have serious attempts at identifying high impact, low probability risk. So, for example, the tsunami would be an example of that. But I've seen companies make quite interesting strides in that area in identifying high impact, low probability risk, and the impact that it's having in terms of how they manage their companies is the way in which they look at their business, and also the extent to which they're making fresh decisions on the risk return ratio, and divesting themselves of businesses where they've now believe that the return isn't worth the risk that they're running on these businesses, and they're relatively low returns based on their reassessment of the risks in these particular businesses. So that's another quite interesting phenomenon where companies are reassessing their risks, looking at high impact, low probability risk, and re-looking at the configuration of their businesses. I don't know if that answers your question, Trevor.
Thank you. Are there any last questions? One more at the back, yeah.
Everyone's going to be offloading tail risk.
Everyone's offloading tail risk. If you can identify it, who's taking it on?
Warren Buffett.
No? All right. Well, with that, I'm going to thank our three panelists and thank you all for participating.